Thinkmarkets have introduced dynamic leverage. What does it mean for you as a trader? That's what we're going to break down in this video, and also try to answer questions that people usually have around dynamic leverage. So firstly, what is it all about? Well, it's the ability to open bigger positions with just a small initial deposit. To give you an idea, say that you want to buy a house for $100,000, then usually when you go to the bank, they will lend you money. But how much then? Well, to keep it simple, imagine they lend us 90,000 and we put down 10,000 for this purchase. Because the house has a value of 100,000 and we are putting down just 10,000, then we have a leverage of 10x. Now, dynamic leverage is a leverage that changes depending on the position size. But in short, what we're dealing with here, if you're a trader, is that you can open quite big positions with very small deposits. In fact, you can have leverage up to 2,000. What's the benefit of this? Well, the benefit of this is that before, when you open a position, you just had to put the margin aside and you couldn't really use that for trading. So you need to put the margin plus an extra buffer for the market to move around. But now, because this initial margin is lower, you don't actually have to put so much money up. And this is beneficial for traders that want to scalp or trade short term. Because if you're looking to make maybe 10 pip a day, then you have to have quite big positions to be able to make it worthwhile your time. And that is what the dynamic leverage unlocks. So let me just explain to you with an example. So here, for example, we're looking at GBP USD, and here I would like to open a 100k position. So with this account, by the way, which has leverage of 100x, if we would open this, we need to multiply the exchange rate with the unit size. So that will be 100,000 units multiplied by 1.2162. And this gives us a total value in dollars of 121,000. And if we divide that by the margin requirement, then that's 1,216. So if you see here, that's 100 times effective leverage. So I need to put down $1,216 to open this position. Now, what if I would switch then to an account with dynamic leverage? With the dynamic leverage, to open the same position, I only need to deposit $60. 60 out of 1,200 roughly, that's only 5% of the original amount. Here, I actually have 2,000 leverage. $2,026. Now, what's interesting here is that, again, you don't have to put $1,200 to open this position. It's enough with just $60. So the great thing here is you can actually start with smaller amount of money and still be able to open big positions. And this is very interesting, especially in today's environment. A lot of traders want to open prop trading accounts. Why? Because they pay maybe $500 to $1,000 and they unlock a 100k account and then they trade this. But we know that there are some very strict rules you need to inherit to, number one, unlock those prop accounts, and then you have very strict rules on how much you can lose. So what happens is that you very much tie down. Here, for example, you could open positions, a 100k position, like you could do with these accounts. But again, you don't necessarily have to put down $500 to $1,000. You could open up with far less money. Now, the margin requirement, okay, it's important to understand, if I would open this position, I would still put on some big risks. So it's not just enough to have the margin, you still have to have a bit of a buffer. Just to give you an idea, if I wanted to open this position and I want to give myself 30 pip stop loss, I would still have to have another $300 in my account. But the beauty here again is that you're not tied in. You know, with $1,200 before, you could just open the position and then that was it. Now you can actually open the position and still have more to spare. For example, this would technically be that you have 120 pips to work with which before that was locked in and you couldn't actually use that money. So what's the dynamic part of dynamic leverage then? So let me explain. So most of you are probably going to be in tier 1, and it's just after trading and trading up your account that you're probably going to go higher. But what I just showed you was Euro USD, and they're in tier 1. So here, for example, because I opened a lot, my margin requirement was 0.05%, and my effective leverage was this. Now, if I would go and open another position on top of this, then the second position would have a slightly higher margin requirement. So when you start to push and have bigger and bigger lot sizes, your leverage declines. But you can see here, we're talking about gigantic positions for the typical trader. So this obviously becomes quite irrelevant. Now, the way the different rules they have, which is important to bear in mind, is that because there's more risks around the opening and the closing of the market, a position 1 hour before the market close or 1 hour after the market opens, then the margin requirement for those positions open at that time would be higher. So what's the trick? You just don't open positions around that time. Now, if you would, for example, have opened a position just as the market opens, then yes, your margin requirement will be higher, but later when we move away from that time period, you would see the margin being released and you can again start to use it again. A question we usually get is that does the balance impact the dynamic leverage tiers? The simple answer is no. It's all about the actual positions you have opened and the settings on the account. So even if you would have lots of money, the margin that is being taken from your account will still remain low. Also, bear this in mind, it's about the net positioning. So for example, if you happen to be long 2 lots of Euro USD and then you decide to go short 1 lot of Euro USD, then you're releasing some margin because you would only be using margin for that 1 net long position. Another question is, do we have swap-free accounts? Yes, we do, and we do have this for ThinkTrader. If you wanted to test this on a demo account, will it be available? Yes, it will. And another very typical question is, will there be any other changes? No, no changes at all. So spreads and products and the different markets that we're offering are still there. It's just that the leverage has changed. And if you wanted to see what markets have more or less leverage, then you can just look it up here on Thinkmarkets. Alternatively, the easiest thing is actually just to open the trading platform and see how the margin changes. For example, you can see if I wanted to open up 2 lots, you can see how my margin requirement is not 120 as you would assume. If you click here, this is 60. This is 1 lot and this is 60. Yeah. If I double this, it's not 120. It's actually 182 because the second lot there requires a bit more margin. How about the margin stop out level? So the margin stop out level remains still at 50%. What does that mean? Is that when you open the position, you put the margin aside, but when you have lost half of the margin, the position is automatically closed out. How about negative protection? Does that still apply within your account? Yes, it does. How about the dynamic leverage? How does it change? Do you as a user need to do anything? No, not at all. Each time you put a position on, the margin calculation changes by itself. You just need to keep an eye on there and see if you can open it. Very straightforward. For example, if I wanted to open this, I need to make sure, do I have enough margin? Yes, I have $1,000. And then I want to place a 20 pip stop loss. So this plus this, that's almost $600. Do I have more than $600 in my account? Yes, I do. And then you are welcome to go ahead and open that. And that is it for the dynamic leverage tutorial here at Thinkmarkets. If you have any questions, you're most welcome to contact our team. Thanks so much for watching, and feel free to leave any questions below the video. Thank you.